All right, so what do tariffs have to do with mortgage rates? So here's the deal. When markets get nervous, investors want to put their money in the safest place they can. And that means they usually pull their money out of stocks and put it into bonds, particularly US Treasury bonds. So that leads to bond yields going down. And think of this like if more people want to put their money into bonds, then bonds don't have to pay as high of an interest rate to those investors. So that's what it means when yields go down. It's more complicated than that, but that's essentially the result. All right, so what does that have to do with mortgage rates? Well, 10-year Treasury bonds are essentially competitors of mortgage-backed securities. So when 10-year Treasury bond yields go down, that means mortgage-backed security yields go down, which means mortgage rates go down. So ironically, with all of this economic uncertainty and the stock market looking pretty tough, it's actually good for mortgage rates. So what does this all mean? If you're a buyer or if you have a mortgage rate over 7%, that's something you might want to pay attention to. It might be time for you to refinance with that rate over 7%. And you might want to take action now to see if it makes sense for you because mortgage rates can bounce around and this is going to be a pretty volatile market that we're going to be in. So you got to kind of strike when the iron's hot and rates drop when they do like they have. So if you want to see what that means for you, or if you're a real estate agent and want to see what it means for your clients, please reach out to us at Novum. We're happy to run the numbers for you and give you some real answers. Thanks.